S&P 500 has one of its worst weeks of the year, but held a minor support level, closing green on Friday. The Nasdaq had its third week of lower lows, but stopped at the gap fill. We'll talk about what to watch. S&P stocks above their 200-day moving average is sitting at a critical level. Why equity traders want to keep their eye on the US dollar right now, specifically its relationship to the Japanese yen. Why Japan's 10-year treasury bond has become very important to the US Treasury market. We'll discuss what made the VIX bottom on July 27th and why option traders should pay attention to this. Bitcoin's 10% correction in a day. The one line in the FOMC minutes that has everyone concerned. NVDA's earnings are this week. We'll explain what Friday's action told us was telling. Apple investors are trying to defend a critical level. Evergrande, one of the largest real estate investors in the world, defaults and seeks bankruptcy protection. We'll explain what this means for the US real estate market and how to benefit from it. Tesla's freefall and why it's accelerating. We have a ton to go over. Let's get to it. Hey everybody, welcome back. 43.82. You can see where we closed right there. You can see our level right here, how we made that 1, 2, 3 lower low. Is that something we need to be concerned about? Yeah, we definitely should be concerned about what we're seeing out there, and we're going to tell you what to watch for a little bit later. I am seeing some conflicting signals, and I think we should talk about it so that we're aware of what to look for. So if we just look in this area and we look at how we've been behaving, and then we drill into it a little bit, we just start with the minor levels, right? And just go here. And by minor levels, I mean ones that we're not going to be worried about next week, but just understand where we are. So we can see that our major support and resistance has been what? This 46.33. Now, why do I refer to it that way? Because you can see in here how that level at one time was support and now it's resistance. Remember, these levels flip. And that's one of the reasons why I always refer to them as key levels. I don't really refer to them as this is always going to be resistance because we don't know that. At one time it was support. And that's a very important distinction where even before where you could see you tried to get up there, you were just unable to. And then it flipped here, right? So you note now that it's flipped and now it's resistance. It's a level that we have to know is out there. And it's really that, 46.20, 46.30 level. For now, it is resistance. It's a minor resistance level to us now because we're so far away from it. In other words, do I really need to be worried about this on a Tuesday? Well, if we go up 6% on Tuesday, we don't have any issues. So it's very low on my rate of things that I have to worry about right now. What I need to worry about are more of the levels that I'm near that were once what? Resistance points. So you can kind of see where I'm going with this as right in here. This is now a resistance point, and then it became a support, and now we've tested that support and we're holding. The question is that going to hold or not? And the answer is, I'm not sure. So I have a 12.22 cross. There's nothing about this, as I like to say, that should make you feel, I'll get this sooner or later, warm and fuzzy. Nothing about that should make you feel good. You can see the breakdown in here. I'll get rid of this in a moment now that we're daily. And now I've got what? A 55.12 cross. Well, all right, so we have these crosses. Let's talk about this for a second. Moving averages are lagging indicators. They give you directional bets, but they're lagging indicators. You want to act on them as soon as they move because they're lagging indicators. So when you break a 55, it's always nice if you try to put a short on around there, and we'll get to one name that is very clearly holding its 55. Really strong name. I'm actually surprised. So if you can see how you're rolling here, do you really want to buy long-term into a declining 12, a declining 22, and the 55 that looks like it's going to cross? And the answer is long-term, no. Short-term, maybe, and we're going to get to that in a moment. But look at where the RSI is right now and how you're breaking 30. People will say this is a lagging indicator. I will show you exactly how we use this on Friday to close short positions off the open, and did not add to short positions on Friday, and that saved people a ton of aggravation and money. So I'm going to walk through that really quickly here in a moment, but you can see where we're at. What I would suggest is when we see something like this, we have a doji, we can all make excuses on why that doji's there, right? We can all say, oh, it's a doji because it's Friday, it's option expiration. All right, you walked in on Friday, you had Evergrande blowing up, which we will get to. And after you had Evergrande blowing up, you had a lot of earnings releases, whether they were good or bad, it hasn't mattered lately. It mattered on Friday. Those earnings releases on Friday, what happened to them? They actually went the way that they were supposed to go. And we'll go through a couple of those, but we should talk about it real quick and just say, hey, AMAT was good. It was good. Now, I'm surprised in the action. I'm going to be candid. I'm very surprised in the action. We were below the 55. All these names are breaking. They raised guidance. It was a solid quarter. There's very little to say about that. If you look at raw stores and you look at how that acted, well, it absolutely exploded to the upside. So it's definitely something that I would be paying attention to here. It's definitely something that I would be paying attention to here and seeing how it goes. We're going to get into this a little bit more in a second, but let's get back in just to the indexes so we can talk about this, and then we're going to get back to the ES. I just want to point out what's going on in the indexes themselves, and then we can kind of get into some of the other, like, really more micro stuff. So if you look at the indexes, okay, I see this, and that is negative, and we shouldn't be feeling warm and fuzzy about it. I see the 12-22 cross. For those that are new, I use a 12, I use a 22, and a 55. You should use what you're comfortable with. So here you have another doji. Well, I've got earnings that are imploding. We're losing this company. We're being told that China's going to collapse. We're flat on Friday. This might tell you that a lot is baked in, and we're starting to see signs of that. So we have to be real cautious here that when we're up here, and we're all calling for new highs, which I still think we can hit new highs this year. And then when we're down here and then people are calling for, oh, well, we're clearly going to have a credit event. I don't know that. I wasn't invited to that conference. I'm not aware there's going to be a credit event. I know we think there's going to be a credit event. I know that when we think something is going to happen, it usually what? It does not happen. Go ask how many people had regional bank destruction on their bingo card last year. Zero. Zero people were talking about it, and it was obvious, but it was not on the radar. So if we're talking about it, it's probably not a problem. That's what I've learned over the years of doing this. But this doji, it kind of makes you want to take, and understand why that happened. All right. So now we look at that, and now let's go take a look at this on a weekly. Okay. So now we look at this on a weekly, and there's a couple things here that are bothersome, and we're going to address that. So number one, we are closed below the 12-week, which is new. Number two, we've broken the 70. Once you're above the 70 and you break below it, you usually have a period of underperformance. And you can kind of see that here where you had a period of underperformance. You don't know that you're going to get this. In this case, we got this, right? Which, if we really look at it, what was that? And we should really drill into this. And we're going to spend some time on the indexes. Okay, so we corrected 8%. Okay. I mean, it's not the end of the world, guys. Every 18 months, you should have like a 10% drop from the high. I mean, that's just normal. People aren't used to normal because they've had a zero interest rate environment for 12, 15 years, and they thought that was normal. And the fact that we had 1.7 trillion injected in the market, so everybody thought they were a genius, right? Everybody came out with a new cryptocurrency or bought a new ETF or bought a new NFT, whatever, right? No, it was that there was so much cash in the market. You can actually see that. Look how tight we were here versus how this is. This is what a market looks like when you don't have government intervention versus when you do. Anyway, so the trading wheels are off, guys. So you can see here how you're cracking and you're starting to get weaker. But when you see this, your antenna has to go up and say, oh, well, that's not great. No, it's not great. And we can see that if we just very simply go and take a look at this on a weekly and just look at the pricing and we look at the action, we're going to say some things here that are going to be very similar to what we just said. So I'm going to just drop this right here for a moment and we can see that level very clearly. Now, what did I say earlier when we looked at the ES? Well, we talked about the ES and we said that this is resistance. Is it? Okay, it is. It's currently resistance. But at one point, what was it? It was support right in here. All right, so if it's support and resistance, what I'm trying to get you to do is not think of things as solid. I'm trying to get people to think of them as key levels that are demarcation lines. If I cross this and stay above it, is that good? Yes. Okay, if I reject it and go down, is that good? If I'm bearish, it is. So these are levels that we just need to watch and pay attention to. And then we can act predicated upon how they act off those levels. And how would you do that? Well, you would look at this, for example, here and say, well, we rejected the wick. I need to get over that wick before I start getting more involved. Okay, well, I've got a bearish engulfing here. If I make a lower low, we're probably going lower. All right, that seems like a fair assessment to do at a key level. And that's how I would suggest that you look at these versus getting trapped in going, well, we have to stop here because it's resistant. Do we? I don't know that. And just like people saying there's a credit event, I don't know that. I'm going to point out some things that could show you that there's a credit event very shortly here, but I want to spend time on the indexes so you just get it. So here we are, and we can see our next what? Key level. Next level of support and resistance. What is it right now? Well, very clearly it's become resistance. It's no longer support, and we should be able to see that very clear, right? And then if we just kind of took a second and pulled that over, geez, I wonder at any time, was that ever support? Well, here was support, flipped to support here, was support here, and then it flipped to what? Resistance. Okay, looks like another key level at 15,220 in that area that we should probably pay attention to. What is concerning about this before I show you something that's very concerning? The light concerning stuff is going to be something like this, where you have this level, and you want to kind of look at these and see how you're acting on them. Is that going to break? Is that not going to break? I mean, that gets you to 14. Is that possible? Of course it's possible. You see that 13.7 right here. So that's your crux. And that's where you could get to. 13.7, you might want to remember some of these levels. We're going to go through a lot of levels today, and you might want to just screenshot them or just mark this so that you know where those timestamps are going to be. So this is definitely something that I would be paying attention to, and then we can kind of go from there. All right, now we understand where we are in the chart. We understand how we're rolling. Now, this is something I use to determine long-term trends. Okay, long-term trends, not short-term trends. So I'm going to show it here with NQ. You can also do this and look at the Qs, and you can do this yourself. This is rate of change that's down here. I do have proprietary indicators. This is not one of them. This is just rate of change associated with actually the way the TradingView has it set up. Just FYI, I get asked a lot about my levels sometimes because people look at like RSI and MACD and go, why are your levels different than mine? That rate of change does exactly what I'm saying it is, rate of change. It's just a momentum indicator. And really what you want to do, and the way that I use it is I will use it for divergences, because there will be glaring divergences which will give you a clear signal that something is wrong. And I also use it just for the zero line. The zero line is one of it's just so simple. If you look at this zero line that you have down here, you will underperform when you break the zero line. You will outperform when you break the zero line to the upside. It is really that simple. And you can even see these markings. I'm going to just show you a couple before I actually get into the equation. But if you look at these levels right here and you see how you're responding every time you got to that zero line, and again, this is rate of change. Anybody can do this. I'm not worried about this. I'm worried about this. The fact that I'm below the zero line. I need to pay attention to that. I'm going to show you some things that are actually beneficial to the market that are going to make you think even differently, like, well, I thought he was bearish. My goal is to analyze what's actually going on and then to figure out how to profit from it. So you will hear me bearish and bullish, and people say you flip-flop in a week. I don't wear a hat. I have a belief on where the market's going, but it's really important for me to just keep an open mind, because at the end of the day, the game is to win, right? It's not to be right. There's a distinct difference there. And I think that gets lost sometimes. And we all have egos. So anyway, you can just see how you're acting here and what happens when you break that zero line. All right, so you broke that zero line right here. How'd that go? Not too well. Broke that zero line. Okay, not too well. So do I want to break that zero line again? Well, there's a difference going on here as well. We have this what? You have a downtrend here. So maybe the significance of the zero line carries more weight. Okay, we could make that argument. Whereas when we broke the zero line this time, we had a what? Uptrend. So maybe it doesn't carry the same amount of weight. Okay, it doesn't carry the same amount of weight until it does. So I don't know how much weight this is going to carry or not. I just need to be cognizant of that. So we understand that it is a momentum indicator. We understand we want to watch the zero line. And I just think that it's really important for people to understand how this is calculated. So really what you're going to do is you're going to take the closing price. This is how it's calculated. They take the closing price of any of these numbers, the most recent number this week, for example, to get this data point. They're going to take that closing price, and then they're going to divide this by the closing price, okay, minus a number. In this case, that number is 9. So what they have it set up as a 9. So basically what they're doing is taking the last 9, right? That's how they're looking at it and going from there. That is the way that it is calculated. end here. I can actually drop this in really quickly. So there is the rate of change calculation. You can see it for yourself so you understand how it's calculated. Now, if you move the N, and just understand this, I don't want to go too much down this rabbit hole because we have a ton to go over. If you change the N, you're going to get a differentiation in line. Okay, so you're going to get a fast trigger or a slow trigger. So in other words, if I go here and then I just go to this and I click on it, now you see where I have a 9. That's the standard settings, a 9. It makes it actually, I get it, but let's just go through this. Watch the line as I do this. See how that line changes? Okay, so you're going to get a smoother line the further you go out. That just makes sense, right? If you want a faster trigger, okay, you would just shorten the line, all right, and that would give you a faster trigger. I think we could talk about when to do that in some kind of video. If that kind of stuff's interesting on when to manipulate these things and change them based upon time frames, just comment below. You know, I try to get into some intermediate and advanced stuff while we do these because I don't have the time so much for the educational videos to throw this stuff in while we're trying to plan for next week. But this kind of stuff you need to pay attention to. So I would just throw this as something that you should look at maybe once every week, once every month, and just look at it and go, hey, you know, what's going on here? This is a concern, and it's something that we have to pay attention to. Now, we take a look at the weekly and we go, okay, well, we know where these quote key levels are, note the change in term. And then you come here and go, well, 13.7, is that possible? Yeah, that is. That's very possible. We're breaking down here. Yeah, we could come down to 13.7. This is the 200 week. Yeah, that can happen. Whether or not it does happen, we don't know yet. Now, there's some things that we should really start drilling into here before we go a little further, because I want to spend more time on the indexes, believe it or not, because there's a lot going on. And I want you to be able to do the same exact thing that I did on Friday for yourself. And if you haven't picked up from these videos, that's what we're trying to do. We're trying to give people the tools to be successful. So I do appreciate when you share these. You'd be surprised at the emails that I get saying, hey, so-and-so shared this or tweeted this or put it out on Instagram, and I really like this one thing. Thank you. So it's very helpful, and it means that I don't have to run ads in the middle of these, which I get asked to sponsor all the time, and I'd rather not do that. And that's how YouTube actually, they like the algorithm. The algorithm likes that because they get paid. So here we are on the hourly. Why is this important? Well, you were in our pre-market lives, which are public. You can see the head and shoulders here. Left shoulder, head, right shoulder, all right? And then you have your line right here. You broke your neckline, you retested your neckline, and then you just made lower highs the whole way down. And now we talked about how this was going to accelerate, and what did it do? It accelerated. Okay, so now we know where we're at. Well, how could you look at this on Friday and suggest that we're going to bounce? How do you look at this on Friday and suggest you're going to bounce? Well, you could do it a couple different ways. One is by the third time that the trajectory changes, you usually have some kind of bounce. By the third time the trajectory changes, you usually have some kind of bounce. Okay, well, let's see what that looks like. One, what do I mean by the trajectory changing? Let me show you. Two, three. Okay, so by the third time you have the trajectory change, you get some kind of bounce, right? Makes sense if you think about it logically. Oh, you have the people, we're just going to have a light pullback. Oh, it's a little more than I thought it was going to be. And then by the time the washout happens, you're sitting there reevaluating your life. We're going to have to leave that in. I don't have time to edit. You're reevaluating your life, and you're looking at this and going, well, I'm just going to get out. I can't believe the market's wrong, blah, blah, blah. We all know this conversation. We all have had it with ourselves. So we have our levels. Okay, so how do you, besides trying to calculate the trajectories on an hourly, what's another way you could do this? You could look at RSI. Now, I have this saying, and the saying is that I see a lot of people go out there and say, oh, RSI is a lagging indicator. It's a lagging indicator for you if you don't know how to use it, all right? And I always use the same equation or the same analogy. If you put a hammer in my hand, I'll be lucky to hang a photo. If you put a hammer in someone else's hand, they're going to build you a log cabin, right? There is a very distinct difference in indicators and the people that can use them. Like, for example, Ichimoku Cloud, it took the guy 30 years to create. If someone watches a 2-hour video and says this doesn't work, I have to think about which person I'm actually going to listen to, all right? So you can see this key level right here, 44.10, kind of bounced off of it. So we come in on Friday, and the first thing I note is that we're gapping down. So as we note we're gapping down, the thing that got me was that this was where we were Thursday. And I saw how we acted, and now we're opening up right around here. This is a 17, and for those that don't know RSI, a 30 is oversold. When you're at a 17, you're in a level that you are normally not in, and you can see now why we're spending so much time on just the indexes before we get into the other pieces. So then you come here and you go, okay, well, here's that level. Let's make it that exactly where it was. Let's get that 17. All right, so here's that level. Now let's just go back to June for a moment and say, how many times have we been here? Well, we've been here a couple times. All right, so how did we respond on those days when we were here at this level? And we can see them all here. And let's just kind of mark them off and go, well, here we bounced, okay? So maybe that's something we should pay attention to. Okay, well, how did we do here? Well, we bounced. I'm not talking about the lows in, although there are signs when you have these divergences. And I'm sure you see that divergence right here, right? And this is what always gets me. I just laugh when people say like, oh, well, it couldn't possibly be that simple. Yeah, it kind of is. See that divergence? I mean, it told you that you bottomed, right? If the RSI chart's the magnitude of the move. If the magnitude of the move is not going lower, how in the world is that going to stay lower? It doesn't make any sense. If you think about it just from that standpoint, it just doesn't make sense, right? If the magnitude is not going to drop, then how is this going to drop? It doesn't mean that you just buy it, but you need to be cognizant of that. And then you look for an opportunity and you give it a shot. All right, so back to this. So this is where we are right here. And we can see why this would be a level of significance that we think we couldn't bounce. So if I look at this and go, all right, so even here, and you go, all right, well, do I really want to be in this position where, and we'll even use the other ones, where I'm shorting into this? How has that gone? Well, not very well. So if I know that this is about as bad as we could get, unless you have a quote credit event or something like that, I want to be covering my shorts into when you're shorting, because now I have supply, right? I have everyone and their mother knows that Evergrande had a bad day. If we're worried about something, it's not the issue. Now look at this on a 4-hour, and I do look at 4-hour charts. And you'd have to look at this and go, well, what happened the last time that we were down here in this 4-hour? Well, we bounced. Okay, well, did we bounce a lot? Well, you'd have to define a lot, but if you take a look from these levels from where that bounce happened, right? Everyone can see this divergence down here as well. And you go to the top of that, well, that's 3%. Let me show you this divergence so that you can see it. All right, see it? Okay, so you know it's coming, you just don't know where. So you look at this and go, okay, well, did we bounce? Yeah, you bounced. Okay, now where did we get to on that? Well, there's a couple different ways to look at this. You could make this argument that, and this is all of 23, just so you know how low you are. That's what I'm trying to point out. Look how low you are. It doesn't mean you can't roll back up and roll back down. That's not what I'm saying. I'm saying, is this the optimal place to put on short positions? The answer very simply is no, it's not. And you should be able to see that. Now, if you go here and you just say from this level, and I short right here when it gets back over, where did the market go from there? All right, 2.5%. Okay, so I had a 2.5% bounce in the market. All right, so where would a 2.5% bounce? Because this is really, we just get serious. This is the only time you've been here. And if you look at that level and you just mark it off and go, well, what was this event? Well, this was a regional bank crisis. Okay, well, we dropped another 5% from there. And then what did we do? After we washed everybody out, okay, from the peak, you went up 20%. So when you look at this on a 4-hour chart, and you're just looking at this. Now, there's some other things about this that we're going to talk about, and we are spending a lot of time on the ES on purpose. And I get it. If you're looking at this kind of stuff, you're going to go, well, we just broke here. We have another one we broke. I got it. But that doesn't mean that you're going to go straight down. And I think that that's the issue that I'm getting at. I would watch this 4-hour. I'd watch this very closely. It is the second time all year you've had a reading this low. And that hourly chart is something that I use all the time. When I just showed you this on an hourly, I use this all the time to make decisions upon what I should be doing with positions that are shorter term in nature. And it works. Okay, so in other words, same exact side, if it's popping over this, we're popping over. Do I want to be long or short? Okay, get it? I want to be selling into you, right? I want to be selling into the supply, or demand rather. I want to be selling into the demand. When I have supply down here, I want to cover. I don't want to cover my shorts when everybody wants to cover their shorts. I want to cover them when nobody wants to cover their shorts. I get better pricing. I want to sell when everybody wants to buy, not when everybody wants to sell. All right, something to think about. You might want to watch that again. Let's go, because we have a ton to go over, a veritable ton. So I want to go through this very quick so people get this. We've gone through this a couple times, but really what you're looking at here is the S&P stocks. Let's get back to this. S&P stocks above the 200-day moving average, and then you kind of look here at the 80, and here's the 40. Why is this important? This is something else that you can do on your own, and you don't need me or anybody else for. All right, See these levels, that 50? Every single time that you break the 50, every single time the S&P outperforms or underperforms. Every time you get above it, guess what it does? It outperforms. Above, outperformance. Below, underperformance. Above this line, above that line, you get what? Outperformance. Below that line, you get underperformance. You can go and mark this yourself and what happened in April and the market. You can go look at when the market ripped, all right? And there's certain telling things about this. When you get to 80, that's a pretty high level. Anything like up here is pretty insane. When you get to 80, it's a pretty high level, but you're going to want to watch this. And here is what you would just type in. And if you close below 50, you want to know that you're going to underperform. So while we're talking about all these moving parts and what's going on and all these other things, this is something very simple demarcation like rate of change that you can do for yourself and you can watch, all right? You're at a crossroads right now in the markets if you don't get what I'm trying to put down. So we're going to look at the dollar here, and I just want to get everybody to understand this. So if you look at the dollar and you understand that what did the market do in 22 when the dollar was ripping. And I don't think I really need to show anybody this. I think we're all aware of what happened when the dollar was ripping, okay? The dollar rips, equities drop. The dollar rips, equities drop, right? We all get that, okay? And then at the same time, we take a look at the 10-year. What did the 10-year do during the same period of time, right? The same exact period of time that the dollar's ripping, what did the bond market do? It ripped, okay. When did the market bottom? Right? The same day that that CPI was released was also the peak in the 10-year. Wonder what else that would have peaked at. Anything else roughly close to that? Right around the peak of the dollar as well, okay? See how this is all tied together? Dollar rises, bond yields rise, equity prices drop. Might want to listen to that again. All right, so here you are, we crack, and now you're coming lower low, and everyone's saying, oh, well, the dollar is definitely coming back. It's going to come back, rates are going to go higher. If rates go higher, then equity prices are going to drop. All right, so we just moved from July here, and we just moved all the way back here. Now, you have a trend line here, all right? Okay. And then what you might want to do is clone this trend line. That's why that function is there, and just see if that fits anywhere. All right, so do I want to be buying at the top of a channel, or do I want to be buying at the bottom of a channel? I probably want to sell into the channel, right? And then I probably want to buy at the lower end of the channel. Well, that would make sense. All right, so if the dollar's rising and yields are rising, well, equity prices are going to go lower. Well, what happens if the dollar is actually in a channel and then starts to roll over? Well, that can't be the case because we're told that with what's going on with Japan and what's going on with Evergrande that there's real problems. All right, well, here's the 200. How do we respond to that? Oh, we're clearly through. Are we? Is that clearly through? It looks like a bunch of dojis to me. Dojis are what? Signs of uncertainty. Okay, if you get through, you need this to curl up, you need to be above it for 3 days, and you need to make a higher high to have a confirm. Do you have any of that yet? No. Let me tell you what you do have, and that what people are not paying attention to. You have a cross that, to me, is way more significant. So I use a 55. You should use whatever you want to use because that's what's important. Here's my cross right here, and it's called a death cross. Are you above that yet? No. Okay, I'll tell you what I see. I see that the 200 has the potential to cross back over the 50 or 55, whatever you want to use. When you have a death cross, your resistance point on a death cross is the 200. It stays that until you are above the 200 and you get a golden cross. Until then, this is in control, period. And no matter what you say or what anybody says, you have never been above this point. And yeah, I look at these points. Because those points are the only thing that's going to get this to get a true cross. You're going to have to be above this unless you really fell down. And even then, most of the times, you're still going to have to try to get above that level at one point. Even though you don't see a point there, that is a point that you need to pay attention to. So, all right, so I'm not breaking down in the dollar. I'm at a point of contention. Am I going to hold the 200? I have to look at this and say, yeah, that might be the move. That might be it. All right. So now we understand the dollar, we understand the correlation of the dollar, we understand how the bond market is affecting the equity markets. What's driving this? All right, so then we drill into what is about 14 or 17%, I don't have it in front of me right now, of the DXY is the relation to Japan. All right, why is this important? Well, since they made a statement, and we'll get into that in a moment, on the 27th on what they're doing in their bond market, what's happening? Okay, well, clearly this is going higher. Okay, well, what's the bond market doing in Japan since they made that announcement? All right, so they said, oh, by the way, we're willing to go out there and we're going to buy all these bonds. Now, up here, now why is that a problem and why did this happen in 23? Because they have something called yield control curves. And I just want to explain this so that you understand the next part of where we're going with this. All right, so you have bonds. Here are your bonds. All right, these are your bonds. Now, this is going to denote selling. So I sell this bond. Let's move this over here so that you get this. So I sell this bond even though I don't own it. All right, so I'm selling something that I don't own. I'm shorting it. All right, so I'm shorting this bond. I don't own it and I'm shorting it, meaning I have a buyer. That buyer is expecting payment of the bond and they are expecting payment of this coupon. Well, in 2023, the coupon I was paying was 25 basis points. That means that if I sell $1 million of bonds to somebody, of these bonds to somebody that I don't own, which I am shorting, I owe them 25 basis points. Okay, that means that you're borrowing money minus the currency risk and everything else. And that's why you see the dollar moving and Japan moving because they're hedging out currency risk. But we're not going to get into all that. I just want you to understand this mechanism because then you're going to understand why the bond market's moving the way that it is. And then I want you to understand what they're actually doing versus what they're saying. So then you look here at Japan and you go, okay, so I sold this. Well, why the heck would I sell this for 25 basis points? Well, if you could sell this for 25 basis points, and then you could go out there and you could buy this and get 4% on your money. Why wouldn't you do that? In what world wouldn't you want to borrow money at 25 basis points and then go and get 4% on your money? Okay, so then let's just say between net and hedging out the currency risk, because you have to hedge out the currency risk, right? Let's just say that you're going to net. You're going to lose another 75 basis points. So you're going to net 3%. Now go do that at 4 to 1 or 8 to 1. Okay, so now at 4 to 1, you're getting 12% a year. Who's not going to want that? Well, you want it until it unwinds. And that is what's driving up the bond market. That is what's driving up the dollar. The unwinding of this trade is driving up the dollar. Now, people will say, well, it's got to be more than that. It's this credit event. Maybe it is. Maybe there's a credit event. Maybe there's not. But take a look at this. So this is just from CNBC. It's just a very quick article so you can understand the mechanism that did this on July 27th, which also gets tied to the VIX. Japanese yen strengthened 10-year yield, spiked after Bank of Japan said it would allow greater flexibility. Isn't that a nice way of saying that we're going to let yields go higher? So yields for the 10-year government bond rose 0.57 for the first time since September 14. Okay, this is what I want people to get. 10-year Japanese government rose 0.575 for the first time since September 14. If you had a trade on, okay, and you in your trade, you didn't expect this because you didn't have it for 8 or 9 years. Are you having a problem with your trade right now? Yeah, you're having an issue. You got to unwind the trade. So after a 2-day policy meeting, they will continue to allow the government bond yields to fluctuate around plus or minus 0.5%. They are weakening their control on it. Okay, so this is the news that came out. Now the question is, why are they doing that? Before we get into why, I want people to understand something on the VIX. Right here on the VIX, you were at a 12. Look at the date that happened. Okay, this is the day that Japan came out and did what they did. So you have the unwinding of that trade that I just walked through. And at the same time, what are they doing? They're buying protection on the S&P. Same exact time. All right. You can see how you're going. The one thing I want to get everyone to take from this, because I know we're going down a lot, is that you have had a 45% move in the VIX in a very short period of time. The percentage move in the VIX and as fast as the move happens affects the implied volatility of your option. You know why you're buying options and they're not moving? Because you're up 44% in a very short period of time. So the way that you were making money before in options and you're wondering why it's not working the same way, congratulations. You can thank Japan for it. That's why this move. Whereas you were making money on your options, and you go look at your P&L, you were making money on your options all in here, right? June, July, August, you're a genius. And then you can't figure out why you're not as smart as you once were. From when that move happened to here, destroyed the implied volatility. It's happening to everybody. It's doing the same thing to me where it is limiting the gains that I was once making from June, July, and August on option trades. I wanted to cover that because I think that's an important distinction. But take a look at this article. Now, this is from the Nikkei staff writer, and this is actually an Asian paper that they publish for us in English so that we can read it, see what's going on over there. Look at this. Japan investors snap up U.S. bonds expecting end of rate hikes. BOJ policy tweak likely to lure money back into yen instruments in second half. Right. Okay. So you see what they did here? They tell you BOJ policy tweak likely to lure money back into yen instruments in second half. But what are they doing? Forget what they say is going to happen, right? What are they doing? Japan investors snap up U.S. bonds expecting end of rate hikes. Okay, so they're doing one thing and they're telling you, well, it's not going to continue because in the second half, they're going to buy the yen. Well, why? Why wouldn't you just buy the yen now? All right, so we have to go down that rabbit hole and understand. We want to know what they're doing. We don't want to know what they're saying they're going to do, right? Watch what they do, not what they say. And I just want to hammer a couple parts of this that I thought were fascinating and that could benefit us. Japanese investors are pouring money into U.S. bonds spurred by speculation Fed is done. Okay, maybe they're done, maybe they're not. We can go down that rabbit hole in another video. Net purchases of medium to long-term debt instruments reached 13.6 trillion yen, 93 billion, during first half, record 6-month period since 2014. Let's go through this again. Net purchases of medium to long-term U.S. debt instruments reached 13.6 trillion yen during the first half of a record 6-month period since 2014. What else happened in 2014? The Japanese Treasury 10-year spiked in 2014. And at the same time, they're buying more U.S. Treasuries. At the same time, a recent policy tweak made Japan government bonds more inviting, with money likely return to the second half. Well, why did they spike, and then why did they buy our yield? Okay, so in other words, here they are again telling you what they might do versus what they actually did. All right. In 2002, when central banks around the world were rising, Japan stayed where they were. Paper losses, U.S. reached almost 5.7 trillion on a yen net basis, the higher ever. Okay, sales. So just so let's go through this. When they were rising rates, Japan investors were forced to sell foreign bonds holding paper losses. Why? They were holding those bonds and they were buying the other bonds, right? So they had to unwind the trade. Okay, we just went through that. Sales of U.S. medium and long-term bonds that reached the 5 trillion yen on a net basis, the highest ever. Sales of U.S. medium and long-term bonds. Well, now we know who was selling, right? We know who was selling. Watch this. And this is the point I really want you to take home. Investors have bought back almost 90% of that amount this year in the first half alone, okay? 90% of what they sold in 2022, they already bought back. All right, now, if we know that this is what they bought back on the 10-year, and I just want to be real clear about this so that we get it, and you can start connecting the dots. So we know that we're selling, that we have a credit crisis, that we need to get out of the bond market right now. And Japan is buying bonds at 2 times as fast. Japanese investors are buying the 10-year 2 times faster than they sold them a year ago. Do you think that they think the yield's going up or down? They think you're near a top. They think you're near a top. And they're buying while U.S. investors are selling, right? That is a very distinct change that we need to pay attention to. And that can affect the U.S. dollar. And that could mean that we may have peaked here. So we're going to want to watch this very closely because this is going to affect this. So I hope that makes sense. You might want to watch that again. If it was too much for a Saturday video, let me know. But it's really important that you get that concept. So when people are saying, oh, there's a credit event or it's inflation that's driving the dollar. No, it's that trade that is literally $1 trillion trade that is moving our dollar, that is moving the treasury market. Those are the mechanisms. You now understand the mechanisms, and understanding those mechanisms gives you an edge. And that's what you always look for in trading. You're always looking for that edge. Now you understand why your options are more expensive. It all makes sense. Now you know why the ES has never been above. If we go back to that level, now you know why in here, okay, that was the high of the ES. Now you know why. Okay, so they're unwinding that trade. Same reason, now you know why that was the low on the VIX. Okay, it's the entire Japanese trade and the unwinding of that on our side of the market, the domestic side, is what's doing it. While we're unwinding over here, they're buying our treasuries. Something to think about as we go forward. Now, we understand that, and before we get into what's going on in the internals in the market and corporate velocity and technology names, which is absolutely staggering, I want to go through one thing that I think is very pertinent. This is the Fed minutes, and this is just fed.com, federalreserve.gov rather, I'm sorry. Anybody can go there. We're going to focus on this paragraph right here. And I just want to take a moment and take a look at it so that you can see it the same way that I can. In their discussions of financial stability, all right, we're not going to go through the whole thing. What I want to do is I just want you to understand some key concepts here. Various participants commented, and they're talking about financial stability right here. Risk could affect some banks. Okay, so some banks could be affected. Unrealized losses on assets could result from rising interest rates. Sure, that could happen. Reliance on uninsured deposits and increased funding costs. Sure, that could be an issue. Participants also commented with sharp decline in CRE valuations could adversely affect some banks. Well, that makes sense because they have loans on it. Other financial institutions such as insurance companies. Well, that's kind of interesting. Why would insurance companies? Okay, maybe because they have exposure to CRE bonds on their balance sheet, but that's kind of an interesting statement. So my antenna went up on that. Like how are they tied? Is it the insurance company? Because the insurance, as long as the premium's paid, what do they care? Well, maybe they have some kind of debt instrument against it or some kind of swap. Maybe there's some kind of swap that we don't understand that's out here, right? So that kind of got me like, ooh, that's interesting. I wonder why they would say it that way. CRA valuations could adversely affect some banks and other financial institutions such as insurance companies. Oh, okay. That could heavily expose us to CRE. Well, how are you heavily exposed? So that's an interesting thing that we might want to drill down that rabbit hole. Several participants noted the susceptibility of some non-bank financial institutions. Okay, non-bank financial institutions could have susceptibility to CRE. That's interesting. What kinds? Money market funds. Money market funds. Several participants noted the susceptibility of some non-bank financial institutions, such as money market funds. I don't care about digital asset entities or to runs or instability. I'm more interested in money market funds. Where you have the majority of money piled in the money market funds, and they're talking about that we are susceptible to instability in money market funds due to CRE valuation. Well, that's a very interesting statement, and that's something we should pay attention to. And that's something that no one is paying attention to, and we should. Now, we know that Evergrande went bankrupt. And before we get into the velocity on what's going on in corporate tech, which will wrap your head around what we're about to go through, I just want to point out CRE, commercial real estate names, were up on Friday. Evergrande filed bankruptcy, and commercial real estate was up on Friday. Okay. The top names, which I consider SLG one of the top names, and let me clean this off, held its 55-day moving average. On the same day that one of the world's largest real estate developers that's in 280 countries with trillions of dollars out there floating around in debt and equity and real estate markets up. Something to think about. Let's take a look at corporate velocity and smart money, dumb money. In front of us is corporate insider velocity. Now, corporate insider velocity, what this is telling us is the speed in which something is happening. And I just want to point out the lines. The green line is telling us that if they are buying, and the red line is telling us if they are net sellers. And they are telling us at the speed in which they are doing this. Not so much even how much they're doing, but the speed and rate of change on what corporate insiders are doing. I found this fascinating and I wanted to go through it. So this is XLK. XLK is the technology sector of the S&P. What we have is we have corporate insider velocity on XLK in front of us, the technology sector of the S&P. I have a 5-year time horizon right here. And if we go and take a look, you can see back here in 18, you can see how the XLK did. And what I want you to focus on is where we are right now. And I'll show you why I want to focus on this. Let's do it this way so that you get it. If you come to this level and you draw a line straight across and you drop that line, how many times are you over where you are now? 4. You only have 4 times when you are over this level. The velocity in which corporate insiders bought their own stock versus selling their own stock at this pace has only happened 5 times in 5 years, and it's happening around. I find that very interesting, and it's definitely something that we should be paying attention to. Now, overall, and we'll get into some more of the charts in a moment, but overall, I found this as a really interesting data point because I always have to be objective about what's going on. I have my belief system, and then you have to challenge your belief system. Here we are in XLK, and insiders are always the first to know, always. And here they are buying. Why are they buying at a rate of change? And then we look at how the XLK has done during this period of time. Insiders always know, they're always the first. Just rule of thumb, it always goes insiders, then it goes institutions, and then it goes retail. Literally in that order. I mean, it literally goes in that order where you want to get in when the insiders are buying, and then the institutions follow, and then retail finally catches up. Now, internet's made things a little different here, and we'll get into that in a moment, smart money, dumb money. But if you take a look at these peaks, now you don't have a peak like you had here in 18, and it's not that you had the most buying here, it's that you had the most buying here at such a rate versus the most selling, the velocity. And they used a 4-week average. This is extremely bullish, this is extremely bearish. If we just go to this and we mark off that level and we can just say it, well, since then you went up. Okay, this was a pandemic. Obviously you can see how that played out. This was just out of nowhere, and you can just see how that worked. I mean, we just exploded. And then you have the peak. Now you have to look at this and go, okay, well, we don't have 30 data points, and you need 30 data points for anything to be statistical significance. Well, I don't have that. This is what I have. I have 5. That's what we're looking at. So then you drill into this and go, we're here now. Are we facing something like just happened that was at the peak where corporate insiders are wrong? Well, I don't know that they're wrong because they had all this time in here to get involved. And so they must be seeing something. And you look at that and you go, okay, well, do we have any other opportunities? Yeah, you had a huge one in 15. Who knows what was happening back here? And let's just draw that line again and just drop it. Okay, so in 10 years, let's call it 10, but you don't really have 10 spots, do you? I think that's pretty interesting. It's not like we're up here all the time on XLK. And you drop it in, you start getting more. If you go out to 11, you drop it in again. And I think that stops at 10. So you have about 13 years. This is not something that I would sleep on. And you start looking at that over 3 years, it's pretty telling stuff. Now, here's the peak again. So it's not a be-all, end-all. We don't know that they're going to be right, but it is a data point going, well, wait a minute, and let's get into the next slide here. Now, this is smart money, dumb money, confidence spread. And this is, we're using here is Sentiment Trader. You can see it right here. I actually spoke to them on the phone and they were fine with me using this. It's a paid service, but they're okay with it. So let's get into this because I think this is really fascinating stuff. If you look at smart money, dumb money, most people will look at this and they will say, well, this smart money right here, you have to follow them because they're smart money. We don't view it that way. We view this as institutions. We view dumb money as retail. Now, if you look at when retail buys, like they did down here, well, retail caught the bottom. Institutions didn't catch the bottom. Retail is catching the bottoms. We want to refer to it that way so that we don't get clouded, just assume that what dumb money's doing is actually dumb. I'd be real careful of this. Well, I'm not going to put my tinfoil hat on and call it programming like institutions are smarter than us. They're not. They're people too. We have this pattern. You can start seeing the slope here from the pandemic where retail's getting out, institutions are getting in. We look at this over 3 years and we have this section right here that has been playing out. We're talking about it and I'm covering it again, but we had this huge separation here. And you can see that separation, I'm sure, pretty clearly, but you can see the peak here and then the peak here. And this was one of the biggest spreads we've ever had, ever in this. I mean, if you go and take a look at it, even this spread was not as big as this one. What is that telling us? Well, that tells us that somebody's out of position. What I find fascinating is if we take a look at this, we are seeing retail get out of this fast. They are getting out of the market fast that institutions can't even keep up with the buying. Retail sells, they're usually in the short term. They usually are. If you mark their peaks, they usually are peaks that you need to pay attention to. And you can see, just mark them from here. I mean, it's glaring. When retail gets out of the market, it's pretty glaring lately. And of course, it changes from here over. And we know why it changes from here over, because we don't have $1.7 trillion behind us. Of course, it's going to change because you're getting what's called actual trading, not as manipulated. You can even see it in the chart. If you look at the S&P, how orderly this was versus how wild this has been. What do we do with this information? How do we benefit from it? Well, this is pretty simple stuff. What we want to do is we want to get to a position where we start to see the smart money or institutions start to cross. Why do we want to see these crosses? Well, if we start looking for these crosses, or what we refer to as inflection points, we'll notice little changes in the market. And those changes usually come around here where you're coming down, and then you start seeing smart money go up. But they're usually marking some kind of inflection point. Now, from my knowledge and looking at them, lately it's been marking a bottom. It's an inflection point. I'm not sure that we're there, that we're going to see something like that. But I would pay attention to this as close as we're getting here, because it does mean that something's coming. Now, if we drill out of this and we go ahead and say, let's drill into this for just the year, and you could see how wild this has been and how long retail's been, really the axe. I mean, they've been the driving force here, haven't they? I mean, we should be able to see that, but it's pretty clear versus how long they were underinvested, and now they're starting to get invested again. Why? Well, they thought the market was frothy. Institutions don't think the market's frothy anymore, and so they're buying. Retail's scared, and we're all talking about bond swaps. I am. We're talking about bond swaps, bond deals. We're talking about the dollar. We're talking about this is going to crash, that's going to crash. That's retail having those conversations. And retail's the one that's panicking right now. It doesn't look to me like institutions are panicking. It looks to me like they're still buying. That is just something else that we kind of have to keep in mind when we start looking at smart money, dumb money, and we have to call it what it really is, in my opinion, which is these are institutions and these are retail. Now you can see, once again, these peaks right here and how that marks the high. I mean, that's pretty obvious, and how these peaks, when they're fully invested, mark the lows. We can see that. But it's not always going to be that way. In other words, do you not buy in April because you're not at a peak? Do you not buy while this is going on if you're already oversold? In other words, if you look at where you're at here, and you come across and you drop a line, and let's go here for a minute, leave these lines on, and you drop a line straight across. If we're at that level of investment, and then this area right here is where retail is. Well, now retail's here already. Well, that doesn't mean that I have more dumping. I've got more selling into institutions. I don't have that here. They're already like, I'm out the door. This was way more orderly if you take a look at that trajectory versus taking a look at, let me change that to this trajectory. If you think about it from that, you're starting to see that angle and you're starting to see that selling. I think that that's something else that we should pay attention to. But this is smart money, dumb money, and we refer to it the way that we just did. And the reason that I think it's important is I think something with this inflection point right here is happening. And I think we need to pay attention to it. And we're closer than we are today. Friday's action is pretty telling. Friday's action to me was pretty telling that at best, we could go sideways. Maybe we'll tick up a little bit, but I think it's there. And of course, we're going into NVIDIA's earnings, which we will discuss. But if we look at this, I would pay very close attention to this. I would not sleep on it. If you zoom out on this, we just did a year. You look at 3, you look at 5. You start looking at these levels, 10, and then you start going, okay, let's go back a decade. Now, if you look at this over a decade, it's always really important to just kind of, when in doubt, zoom out. And so just come here and you're just going to drop this line. When was the last time we were up this high on retail? Now I'm going to mark this off and do it again and leave that up there. See where you're at there? When was the last time retail was this high? The last time it was that high was right here. It was pandemic. Nobody knew that was coming. And you have retail right here, and then here we are again. Well, I think this is worth paying attention to. I think this scenario here is very similar. And what we can do is we can actually zoom in on this. Zoom in on that section. I think this section is pretty similar to what we see as far as the spread that we have right now. If we think about it from that perspective, from a spread perspective, and this is what we have, not the trajectory. This trajectory was a lot slower. This is happening a lot faster. That might mean that if there is a bounce, keyword there, I should say. If there is, then this is something that we should pay attention to. Now, this is a contrarian indicator, and it's definitely one that we want to pay attention. Major sector breadth. Okay, percentage above the 10-day moving average. This charts the 11 major sectors of the S&P. It charts whether or not they are on a percentage average above their 10-day or below their 10-day moving average. And what we're doing is we're taking a snapshot of about 6 months, and 6 months is plenty of time to do this. But for our purposes, just to give you an example, we'll do year to date so you can see it. And then we will also do 1 year. It's not uncommon for this to happen, but let's just take a look at year to date, and then we'll go and do 6 months. It's not uncommon for it to happen, but what does it signify? Well, that's kind of an interesting statement, because when you look at this, I think it's absolutely glaring. And it's one of the reasons why I wanted to show this, because you have these theses and you walk through these theses, and then you start to see stuff, and it should open your eyes one way or another that, hey, maybe I need to ask some more questions. Let's just go through what the heck is that line I just put here. What is that telling you? Well, that is 100%. That is when every stock is above its 10-day moving average. Every sector, I apologize, every one of the 11 sectors is above. All right, you come here and you click, and then you go here, and okay, well, that's kind of near a high. That's kind of near a high, and we pulled back. It's kind of near a high, and we pulled back, kind of near a high, and we kind of leveled off. See, when everything's great, it can't get any better. Okay, I mean, it's just if everything's above There's nowhere for these to go. That's why when stocks, that's one of the things I'll use is like stocks above their 50-day moving average. Once you get to 90, you almost always see some kind of correction. We just don't know how much. But look at where you're at now. You're at the zero line. What does that mean? Well, that means that every single major sector in the S&P is below its 10-day moving average. Okay, that means utilities, XLP, even your defensive ones are below 10-day moving average. Well, that's kind of interesting. Then you start looking at these levels and going, well, what happens here when that happens? And what we can do real quick is just kind of take a look at that and say, okay, well, we'll start here because that's kind of cut off, and we don't know where we're coming from there. So look at that and go, okay, well, that's interesting. And just start using the zero lines because it'll tell you more. It's kind of in there. You're more really in this area, aren't you? And then you go to this zero as well, and that puts you here. So what have we seen over this period of time? Well, we've seen that has gotten us to a point where you could say there's a bottom. Well, let's go out a year and just take a look at a year. And all I want to do are the zeros. Let's get that off and we'll start over again. We already know we have this one. We already know that. We already know that this one exists. Now we have this one here, here. All right, just start marking these areas. And then you come up here and just kind of look at them and go, okay, well, where's that put me? Well, that one didn't work, did it? Here, here, here. Then you look at this and go, on average, once we're at a place where we were zeroed out, if you were to go out 3 months later, is the S&P up or down on average? If you looked over the past 12 months, it's up. It doesn't mean that it's going to be up this time, but to pretend that this is not happening and we get, overly bearish or overly bullish, this is how we get killed. We have to look at this kind of stuff and pay attention to it. We can't just assume that because Evergrande blows up that there's dominoes out there. Usually when we're aware of the problem, that's not the problem. Now, sometimes that's not the case, but we just don't know. I found these 3 slides very different than what the indexes were telling us. And we are seeing some things in individual names as well that are telling a little bit of a different story. See Bitcoin, see how it tried to rally and broke down? This is usually a precursor to the Nasdaq breaking down. So you can see maybe we're seeing a decoupling. People are relating this to the fact that Elon sold some. If you can drop this off a couple $100 million at 10%, that's a problem. And we are defending, or sure as heck trying to defend some levels. You're really trying to defend that 175 level. This is 178 to the top of that, 178.82. But you're really trying to defend that level. If we took a second, put in the moving averages, there's no way that you could look at this and say, I need to be in this. Okay, here's your 12, 22. Here's your 12, 22 cross, your 12 screaming down. You now have, or now you actually even have a 22.55 cross with the 12.22. So you cannot be looking at this and saying, I really got to get involved. When you're this oversold on a daily chart, when was the last time we were this oversold to when we had a pandemic? That's how oversold you are right now. You have to assume that there's a bounce. If you are short this, and we have short positions in this, and we actually covered on Friday a lot of it, like we talked before, you have to assume that you can retest 179, get to the 12, that you could retest this 186. I don't know if we're going to do this, bounce up, come back down, retest, and go again. There's schools of thought on both sides. What I can tell you is that there is a bounce floating out there. Now, I thought this was extremely telling. NVDA has earnings this week, as everybody's aware of. We know that AMAT had a good quarter, raised guidance, gapped lower, took in supply, ripped up, and closed over the 55. We know that. Encapsulates this breakdown of the 55, rallies up. On that rally up, these 3 bars that are coming down could not even get to 50% of that move. When we got to 50%, we held and bounced. You have a major DTL here. This is a reversal bar that could be used as a trigger bar. 435.78. You could push through this. The chances of us getting back through this wick without news before earnings are pretty slim right now, in my opinion. The 55, and if I just did the basics and said, I got over, we broke it, I did not get a lower low below it, I formed a flag, I got below it, and I pushed again. This is a test of the 55, and this is a retest of the 55, and you closed over it. So while I have a 12.22 cross here, I have to respect this. And I would watch this very closely on Monday, very closely, and watch the price action. Because price action changed on Friday to where we are actually rewarding names that had good earnings. We saw that with AMAT, Ross Stores, Walmart that looked like it was going to broke but held that 55. Now, to me, Tesla has cracked, and they are very tied to what's going on in China and the deflation that's going on in China. I don't think he's a marketing genius cutting prices. I think he has to cut prices. I would be very concerned about a couple things here. Number one, I'd be very concerned about this 1222 cross and your inability to get over it. Then you have a 12 crossing the 55. Now you have a 22 crossing the 55. We are grossly oversold. That does not mean that I can't bounce back to 240. And that's what people have to understand. And that doesn't mean that it's over. It just means that you're oversold and you're going to work back to a neutral level. That is how I would look at this. And it is possible for the market to stabilize and Tesla to go down. Remember, as we went over 4 weeks ago, Tesla never broke its DTL. It rejected on its DTL. And from there, it's done nothing but roll right back down. That's it.